Hello, gentlemen, and welcome to another Palavi Market Research video. Today, we're going to be discussing stablecoins, and I'm going to walk you through all the different types. I'm a little bit overly caffeinated today, so we're going to go through this pretty quickly, I think. So, the first is a centralized stablecoin. It's something that's fully backed by fiat, by a centralized institution or business. So, in the case of Tether, there's a company called Tether Limited, and each token, each USDT token, is backed by $1 supposedly, that's held in reserve, right? So they mint a USDT token and then they go and they get one little dollar bill with a George Washington's face on it, right? But again, it's a centralized entity and they are not obligated to really have any transparency whatsoever. And, it's very much due to their discretion. They're able to take risks behind the scenes with those dollars, right? So they're most likely doing what a lot of these other stablecoin issuers are doing, like buying US treasuries, 10 years, 5 years, blah, 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 right? But we don't really know. Okay? Moving on. This guy, Mike Novogratz, though, he will tell you that Tether's super safe. He's seen it behind the scenes, right? All those things, right? And I like Mike Novogratz. Mike Novogratz is just on television all the time, and he makes outrageous statements. I like Mike Novogratz a lot because he actually donates a ton of money to wrestling, and I'm Division One wrestling background, blah blah. No, flex on you guys, but whatever. And of course, I don't know if you know this, but he also backed Luna. He even has a Luna tattoo. Moving on. If we want to talk about the most interesting, what are we classifying this as? Fully backed, fiat fully backed centralized stablecoin. USDC is by far number one. These guys are backed by BlackRock. They very, like you see here, they confidentially, very quietly filed an IPO recently, like in January or late January this year. Guys, this is not financial advice. But if I could, I would put 100% of my money into the latest round in Circle, which is the managing entity that controls USDC. It is my personal belief that USDC is the CBDC, the central bank digital currency that everyone says is going to come any moment now. In my opinion, it's USDC. And in my opinion, BlackRock and all these other companies have bought into it pre-IPO knowing that. And if you've watched my other videos, you'll understand that what's happening here. So every security, stock, commodity, everything, real estate is going to be tokenized. And if it's tokenized, then there needs to be a liquidity pool, right? Underpinning that asset. And that liquidity pool has to be tethered to a stable coin. That stable coin is going to be a central bank digital currency. It's going to be USDC. USDC Circle, same thing. That will probably be the most valuable crypto company ever. Okay? In my opinion, Circle, and this is not financial advice, Circle will very likely be a $1 trillion company that will maybe even pay a dividend. And it's, I think, going to IPO at around $5 to $15 billion. That's some alpha for you. Now, what's a decentralized stablecoin? That's fully backed by third-party assets. So you, a user of DeFi, right? You are the person who collateralizes this stablecoin. Okay, so we're going to talk about how MakerDAO works. So they basically maintain the price of their stablecoin, which they keep tethered to the US dollar by collateralizing cryptocurrency assets like Ethereum into and locking it inside of the MakerDAO treasury. Okay. The DAO needs to maintain this collateralization ratio that ensures that there are a sufficient basket of assets that back the value of DAI. This has actually worked. Like the performance on DAI so far is actually better than USDC. They have had less depegging than the premier stablecoin. Okay. Now they have all these stability fees, and you can kind of read through this if you want. Like I just kind of put in here how this all works, right? They have all these different mechanisms that they use to maintain the price point, right? So stability fees is one of them. And then they have these stability mechanisms as well, like this debt ceiling that they are managing and this surplus buffer that they're also managing. You can go look in that more yourself, but and you can read these specific slides if you'd like also, but I'm not going to just sit here and read it to you, okay? So lastly, there's something called a protocol owned liquidity stablecoin, right? And so this is where it gets really experimental. You've probably heard of like algorithmic stablecoins. Now, technically speaking, all of the stablecoins we just discussed are technically algorithmic stablecoins. But in this sense, right, protocol owned liquidity stablecoins are attempting to provide a stable coin, okay, that that seeks stability without being pegged to a fiat denominated asset like the US dollar, the Russian rupee, the Great British pound, right? So I want to just describe to you how this experiment works because I would definitely classify Olympus as I don't want to call it a failed experiment because there are some interesting things going on in the community over the last year. And I would argue, like, if you look at like the lifetime chart of Olympus, you'll be like, oh my God, this is a failed project. But if you look at it over like the last year or so, you can kind of see that it's actually achieving its original value proposition. And it's possible that the market overvalued its value proposition massively when it initially came out, and it's suffering from that overvaluation, right? Now, so I want to walk you through this flow chart to show you how this experiment works. So basically, Olympus distributed its initial ohm supply to investors during a fair launch offering, right? At the launch, Olympus also started the Ohm DAI Sushi Swap pool. That was like Ohm V1. They actually have an Ohm V2, and most of that liquidity is like on Uniswap, I believe. And then investors either stake their Ohm in the pool for staking or trade their Ohm with other investors. Okay, that's pretty intuitive. Next step is Olympus monitors the price level of Ohm DAI. Okay, so it's measuring the LP price, the liquidity provider price, because if you've ever provided liquidity to a platform, you know that you get an LP token. So it's managing the LP token between Olympus and DAI. The price of Ohm falls below 1 DAI, it will redeem liquidity, take liquidity out from the pool, remove liquidity from the liquidity pool, from the providers, and burn Ohm until the price returns to 1 DAI or above. Okay? Then, if the price of Ohm is above 1 DAI, Olympus will take it as a signal that there is demand for the Ohm in the market, which means that new Ohm will be distributed to investors through staking. So if you're staking the Ohm and the price surges too much, then they'll make more and they'll distribute as a staking reward, a compounded interest to the people staking. Or they can do something even more interesting, which is bonding. And bonding is essentially when you sell a bond in exchange for other assets, right? So it's like exactly how you understand bonds, right? So you buy a contract, and you buy it under a certain asset, right? So maybe they'll say, okay, we'll give you if you give us $1,000 USDC, we'll give you $1,200 worth of Olympus, distributed over the next 2 months, right? We'll just like airdrop you tokens, right? So that's what bonding is. And I'm sure you've maybe experimented with bonding yourself. It's an interesting thing to explore, but it has not been perfected. All of the liquidity backed protocols are currently considered failures. So be cautious if you're, looking to participate or experiment in that space. So this is kind of, the oversimplification of the value proposition behind Olympus that I think is actually a really good description of it. So, as an investor, you buy Ohm and you stake it in the Ohm stake pool to receive that compounding interest we talked about. Then, if you want more Ohm, investors either buy more from the market or bond their protocol assets, right? So, that's what we just described with bonding. Then, those LP tokens are bonded to the protocol or locked permanently in them and inside that ohm DAI pool that we talked about. But that ohm DAI pool is now not on SushiSwap. Then those LP tokens earn trading fees, right? So like they're making money off of that ohm DAI pool, right? Which is obviously the main source of, how do you call it? Like the ohm DAI pool is like the main hub, is the primary source of gravity for this protocol, right? And obviously that generates fees in the form of like Uniswap tokens, right? Or SushiSwap tokens. And those have their own price action tethered to them. And that price action and capitalizing on that is controlled by the DAO itself. And the DAO, in the case of Olympus, doesn't really have any functioning governance whatsoever. So it's pretty much all the people who started the thing managing those token price, like, taking advantage of that price action. Okay. Then with those new tokens, so maybe they sold those tokens and they got a nice profit on those staking reward tokens on inside that ohm DAI pool, right? Then they'll use that to essentially return money to investors, right? To provide you staking rewards, right? Now, this is a very controversial, you know, way of. I mean, you could definitely describe this as a Ponzi scheme, but so many of these things are, like, especially anything that's selling itself to you via its staking rewards is either Ponzi scheme, most likely, or it's too complex for you to participate in. And like this sort of, where it's like, if you don't really understand it, if you didn't start the thing yourself and you don't like know how to read a code base, it's probably too complex for you to be participating in. And then lastly, it's security, and that's illegal to own in this context also. So again, none of this is financial advice. I'm trying to educate you guys on how these things individually work so that you're taking on, so you're measuring risk appropriately when participating in stablecoins, because stablecoins are obviously something that people view as being safer, right? And some of them are. Tether, I would say, is a little bit more ambiguous, while USDC is probably as good as it gets. DAI, like when you understand it, is something that seems DAI is tricky because its history is undeniable, right? I mean, like you can go verify yourself. Like there are some really interesting, like it has a lot of credibility based off of its price history, maintaining its price, right? Maintaining its peg to the US dollar. And then, of course, something like Olympus is an experiment, right? And we want to be tracking these experiments when it comes to creating stable coins that are actually not tethered to fiat, because that is its own unique value proposition that has not that there's a tremendous demand for, right? There's a tremendous demand for an asset that isn't Bitcoin, right? That isn't gold and that isn't the US dollar, right? There's a fourth asset class, right? That people really want, that has like the benefits of all three in one, okay? And that is possible, hypothetically speaking, through this kind of liquidity backed protocol, non-depegged stablecoin experiments that we're going to continue to see over the next 5 to 10 years. Okay. So you may as well track them, learn about them. And tomorrow we'll pick this up again. See you guys. Have a great rest of your day. Yay.